Okay, quick question. How many accounts do you know that give you a tax break 3 different times? Not once, 3 times. In, out, and while it's sitting there growing. Oh wait, if you said 0, you're in good company. Most people have never heard of this, and the people who have heard of it, half of them have no idea how it actually works. They've got one sitting open somewhere, barely touched, maybe $30 in it from 3 years ago. Today we're fixing that. I'm Professor Paycheck, and this video is about the HSA, the health savings account. The account the IRS quietly gave 3 separate tax advantages to, and somehow nobody ever properly explains it. By the end of this video, you're going to understand exactly what those 3 advantages are, who can actually use them, what mistakes people make, and why this might matter more in your 40s and 50s than almost any other account you have. Stay with me. This one's worth it. Let me set the scene. You're probably somewhere in that middle range of life, old enough to start taking money seriously, not so old that you've given up. Maybe you've got a 401k happening, maybe a Roth IRA, maybe you're doing okay, maybe you feel a little behind. Either way, you've got healthcare costs coming, and they're not going down. Here's a number that tends to make people sit down. The average American couple retiring today is expected to spend somewhere in the range of $300,000 on healthcare costs throughout retirement. Some estimates go higher. The exact number depends on a lot of things, but the point is, it's a lot. It's not a rounding error. It's a real financial category that most people have no dedicated plan for, and yet there's this account, this specific account, that was literally designed to help with exactly that. The HSA. Let's start from the beginning. HSA stands for Health Savings Account. It's a type of account you can open and contribute money to specifically for medical expenses. Think of it like a savings account. Except the IRS gave it 3 tax superpowers that no other mainstream account has all at once. Now, before I explain those 3 superpowers, I have to be upfront with you about something, because this is important. Not everyone can open an HSA or contribute to one. To be eligible, you need to be enrolled in what the IRS calls a high deductible health plan. HDHP, that's a specific type of health insurance. The premiums are usually lower, but the deductible, the amount you pay out of pocket before insurance kicks in, is higher than a standard plan. The IRS defines what counts as a qualifying HDHP. Those minimums and limits adjust over time, so you'll want to check irs.gov or your employer's benefits documentation to see if your specific plan qualifies. If you're enrolled in Medicare, you generally can't contribute new money to an HSA. You can usually still keep and use an HSA you already had. If you're covered by another health plan that's not HDHP, you likely don't qualify. If you're claimed as a dependent on someone else's taxes, also no. There are other edge cases and tax rules are complicated. The point is, eligibility is real, and you need to verify it for your situation. Don't assume? Check. If you do qualify, keep watching, because here comes a part that changes things. The triple tax advantage. 3 moments where the IRS does not take a cut. Let me walk you through them one at a time. Tax advantage number 1, the money goes in tax-free. When you contribute to an HSA, that contribution reduces your taxable income. If you're doing it through payroll, through your employer, that money is taken out of your paycheck before income taxes are calculated. You never even see it taxed. It just goes in clean. If you contribute on your own directly to the account, you can deduct it when you file your taxes. Either way, the government doesn't collect income tax on that money going in. That's advantage 1. Tax advantage number 2, the money grows tax-free. Here's the part most people completely miss. You don't have to just let your HSA sit there in a basic savings account, earning a tiny bit of interest. At many HSA providers, you can actually invest the money. Mutual funds, index funds, ETFs. Just like a brokerage account or an IRA. And any growth that happens inside the HSA, tax-free. No capital gains tax, no dividend tax, no annual hit on the gains. The money just grows, and the IRS stays out of it. If you put money in at 45 and it just sits there growing invested for 20 years, you never pay a cent in taxes on those gains as long as it stays in the account. That's advantage 2. Tax advantage number 3, the money comes out tax-free. When you spend HSA money on what the IRS calls qualified medical expenses, you pay 0 taxes on the withdrawal. Nothing. The full amount goes toward your doctor visit, your prescription, your dental work, your vision care. It goes in without tax. It grows without tax. It comes out without tax. That is the triple tax advantage. And before you think I'm exaggerating how rare this is, compare that to a traditional 401k or IRA. You get a tax break going in, but you pay taxes when you take the money out, compared to a Roth. You pay taxes going in, but growth and withdrawals are tax-free. That's 2 tax advantages at most. The HSA, used correctly for qualified medical expenses, can be all 3. There is no other commonly available account in the U.S. tax code that does this. Let me clear something up that trips people up constantly. The difference between an HSA and an FSA. FSA stands for Flexible Spending Account. Also a healthcare account. Also has tax benefits. Sounds similar, but there's a critical difference. The FSA has a use it or lose it rule. Whatever money is in your FSA that you don't spend by the end of the year, you lose it. Some employers offer a small grace period or allow a small carryover, but the basic structure is spend it or it's gone. The HSA has no such rule. The money in your HSA rolls over every single year. There's no deadline. It can sit there, growing, for decades if you want. And you can use it when you actually need it. The FSA is a spend it this year tool. The HSA can be a long-term wealth building vehicle. Same space, completely different game. Now you know the difference. Let's talk mistakes. Because owning an HSA and using it well are 2 very different things. Mistake number 1, using it like a debit card. This is the most common one. People get an HSA, get a debit card linked to it, and they use it for every copay and pharmacy visit throughout the year. That's not wrong exactly. It's what the account is for. But here's the thing. Every dollar you spend from the HSA today is a dollar that isn't sitting in the account growing tax-free for the next 20 years. If you can afford to pay your current medical costs out of your regular checking account, you might want to consider doing that and leaving the HSA money invested. Which leads me to mistake number 2. Mistake number 2, not investing the money. Most people leave their HSA balance sitting in a default cash savings position, earning almost nothing. Many HSA providers offer investment options once your balance crosses a certain threshold. If you're not using those investment options and you're eligible for them, you're leaving the second tax advantage on the table completely. Check your provider's investment menu. Mistake number 3, ignoring fees. Not all HSA providers are created equal. Some charge monthly maintenance fees. Some charge fees per transaction. Some require a minimum cash balance before you can invest anything. Those fees erode your tax advantages over time. Compare providers before you open one, or consider whether switching makes sense. Mistake number 4, not keeping receipts. This one is fascinating. There's no time limit on when you reimburse yourself for a past qualified medical expense from your HSA. None. You can pay a medical bill out of pocket today, keep the receipt, and then pull that money out of your HSA completely tax-free in 15 years. That reimbursement is still valid as long as the expense was qualified at the time, you have documentation, and the account existed when the expense was incurred. That means your HSA can function like a tax-free reimbursement reserve for all the medical expenses you've been paying out of pocket for years. But only if you keep records. Get a folder. Digital, physical, whatever works. Every qualified medical receipt you pay out of pocket, date, amount, what it was for. Keep it. Mistake number 5, not verifying eligibility before contributing. Contributing to an HSA when you're not eligible can trigger taxes and penalties. If you're not sure whether your health plan qualifies, check with your employer's HR department, check IRS publication 969, or talk to a tax professional. Don't guess. Now here's the part I want you to really sit with for a second. The retirement angle. Before age 65, if you take money out of your HSA for something that's not a qualified medical expense, you owe income tax on it, plus a 20% penalty. That stings. Don't do it. But after age 65, the rules change. The 20% penalty disappears entirely. After 65, you can take money out of your HSA for absolutely any reason. Non-medical withdrawals just become regular income, taxed at your ordinary income tax rate. Exactly the same as a traditional IRA. But here's the beautiful part. Withdrawals for qualified medical expenses, still completely tax-free. Forever. Even in retirement. Even at 80. So think about what this means if you plan for it. You max out your HSA contribution every year. You invest it. You leave it alone. You pay your current medical costs out of pocket and keep your receipts. You let the account grow tax-free for 10, 15, 20 years. Then you retire. Healthcare costs hit hard. Prescriptions, Medicare premiums, dental, vision, hearing, long-term care potentially. You have this entire dedicated pool of tax-advantaged money just waiting for that exact situation. That's not an accident. That's a strategy. For 2025, the HSA contribution limits are $4,300 for self-only HDHP coverage and $8,550 for family HDHP coverage. If you're 55 or older, you may be able to contribute an additional $1,000. These numbers change, so always verify the current IRS limits. So what do you actually do with all of this? Step 1, check your current health insurance. Is it a qualifying high deductible health plan? Call your HR department, look at your benefits packet, or check IRS publication 969 for the current HDHP minimums. If yes, you may be eligible. If no, watch for open enrollment and see if an HDHP option is available. Step 2. If you're eligible, research HSA providers. Compare monthly fees, investment options, minimum balances, and user experience. Your employer may already offer one. Ask. Step 3. Consider talking to a tax professional or financial advisor before making changes. Your specific tax bracket, your health needs, your other accounts, your situation. All of that shapes whether an HSA strategy makes sense for you. I can explain how the tool works, I can make it make sense, but I can't tell you what the right choice is for your life. That part is yours. What I can tell you is this. If you're eligible and you've been ignoring this account, it's worth understanding. The triple tax advantage is real. The retirement potential is real. And the mistakes people make with it are also very real. Now you know about all three. Quick but important note before you go. Everything in this video is for educational purposes only. I am not a licensed financial advisor, tax professional, or insurance specialist. Tax laws, contribution limits, qualified expense definitions, and HSA eligibility rules change. Always verify current rules at irs.gov. Investing HSA funds involves risk, including possible loss of principal. This video does not constitute personalized financial, tax, or medical advice. Please consult a qualified professional for your individual situation. That said, this is real information about a real account with real tax advantages. Go learn more. You deserve to understand the tools that exist for you. If this video made the HSA click in a way it never did before, hit subscribe. Professor Paycheck posts every week, and the goal is always the same. Take the confusing financial stuff, draw it badly, and make it actually make sense. If you've got a friend or family member who's been confused about HSAs, FSAs, retirement accounts, or any of this stuff, send it to them. That's how the channel grows, and that's how we help more people. I'll see you in the next one.